You can do everything right in retirement and still get blindsided by a bill you never saw coming, because one decision made at the wrong age can quietly raise your Medicare premiums years later. Picture this. You retire in your early 60s, your paycheck stops, and your taxable income drops like a rock. You finally have what advisors love to call the gap years, that sweet spot before Social Security and required minimum distributions start forcing income onto your tax return. You've got a traditional IRA, you've saved for decades, and you want to convert to a Roth while your bracket is low. Pay taxes now, lock in tax-free growth later, reduce future RMDs, protect your spouse, all the good stuff. So you convert aggressively. You do it the clean way, too. Pay the tax from a separate savings account so every converted dollar lands in the Roth and keeps compounding. You feel proud because you're being proactive and disciplined. Then you hit 65, enroll in Medicare, and a notice arrives telling you your premiums are nowhere near the standard amount. You didn't go back to work. Your current income isn't high. You already paid tax on the conversion. Yet Medicare is charging you hundreds more per month, per person. And you realize the trigger wasn't what you earned this year. It was what your tax return showed 2 years ago. That shock is not rare. It's happening to retirees every single year, especially to people who are doing Roth conversions without realizing that Medicare uses a 2-year look-back. The strategy may still be smart, but the timing can be brutally expensive if you don't understand the rule before you act. This video is educational only. It is not tax, legal, or financial advice. Rules change, thresholds are adjusted, and your situation is unique. Always consult a qualified professional before making decisions with tax or Medicare consequences. Now, let's break down what's actually going on, why age 63 is such a high-stakes year, and how to create a simple plan that avoids unnecessary premium surcharges while still letting you use Roth conversions strategically. Medicare Part B is not one fixed premium for everyone. Most people think it is because that's how it's discussed. Part B costs X per month. But in reality, Part B premiums are income-based. If your income is above certain thresholds, Medicare adds a surcharge called the Income-Related Monthly Adjustment Amount. Most people call it IRMAA. What makes IRMAA so dangerous isn't just that it exists. It's that it works like a set of cliffs, not a smooth ramp. Go $1 over a threshold, and you don't pay a little more. You jump into the next tier and pay the higher premium for the whole year. If both spouses are on Medicare, you pay that higher premium for each person. And here's the twist. Medicare doesn't look at your income right now. It looks at your income from 2 years ago, based on the tax return you already filed. In other words, your Medicare premiums in a given year are generally based on your modified adjusted gross income, MAGI, from 2 tax years prior. So if you start Medicare at 65, your first year's premium is typically based on what your income was at 63. That one sentence is the reason this trap catches so many careful planners. Because 63 is the year many retirees are most tempted to generate extra planned income on purpose. Through Roth conversions, capital gains harvesting, selling a property, taking an IRA distribution to fund a big purchase, or cashing out investments. Those moves may be perfectly reasonable. But if you don't understand the look back and the cliffs, you can accidentally lock in a higher Medicare premium at 65 and often again at 66. Let's talk about the mechanics. Medicare uses your MAGI, which generally means your adjusted gross income plus certain tax-exempt interest. And the big thing to know is that Roth conversions count. A conversion from a traditional IRA to a Roth IRA is taxable income. Even though you might be converting for long-term tax savings, it still increases MAGI in the year you do it, and that MAGI is exactly what Medicare checks later. so you can do a Roth conversion that makes total sense from a tax planning perspective and still trigger IRMAA because Medicare is looking at MAGI, not at whether the move was wise. Now let's put real numbers around the problem using the 2026 premiums and thresholds described here, so you can visualize how quickly the surcharge can stack up. In 2026, the standard Part B premium is stated as $22.90 per person per month for those at or below the first income threshold. The first threshold is described as $109,000 for single filers or $218,000 for married couples filing jointly. Stay at or below that, and you pay the standard premium. Cross above it, and you move into IRMAA tiers. In the first IRMAA tier, above $109,000 single or $218,000 joint up to the next bracket, the Part B premium jumps to $284.10 per person per month. That's not a minor bump. That's a major increase, especially for a couple. Then the tiers continue climbing, $365.60, then $447.10, then $528.60, and in the top tier, it reaches $689.90 per person per month. If two spouses are both on Medicare and both are subject to that top tier, Part B alone becomes a five-figure annual expense, before you even talk about Part D adjustments. Even if your exact numbers differ slightly in real life depending on official updates and how premiums are published, the structure is the same. Cliffs, not slopes, based on a 2-year look-back. Now here's why age 63 feels like a gotcha year. Most people enroll in Medicare at 65. They assume Medicare pricing is about their income at 65. But Medicare's look-back means your 65-year-old premium is built from your 63-year-old tax return. That means the financial choices you make at 63 are not just tax choices. They are Medicare premium choices too, whether you realize it or not. At 62, your actions can still affect Medicare premiums, but they generally show up in later Medicare years. At 61 or 60, you may have more room to do large conversions without that income being used to set your first Medicare premiums, because those years fall outside the first look-back period for age 65. That's why planners often describe earlier gap years as the cleanest conversion window. Not because Medicare never looks back, Medicare always looks back, but because your initial enrollment premiums won't be pegged to those earliest years. But once you hit 63, your tax return becomes the one Medicare will use for your first year of coverage at 65. And because these are cliffs, one oversized conversion can flip the switch. This is where many articles and conversations go wrong. You'll hear, convert while your income is low, which is true as far as income tax planning goes. But low for income tax purposes and low for Medicare purposes are not the same calculation. You can be in a relatively low tax bracket and still exceed an IRMAA threshold, especially as a single filer. You can even feel like you're barely paying any tax, yet the conversion still inflates MAGI and triggers Medicare surcharges. So it becomes a sequencing problem, not just whether to convert, but when and how much per year. Let's look at 3 realistic situations so you can recognize your own pattern. First scenario, a single retiree with a moderate IRA who wants to be aggressive. Imagine someone age 63 who retired at 61 and has a traditional IRA around the mid-6 figures. Basic expenses are covered by a pension or savings. They see a big empty tax bracket and decide to convert $120,000 in 1 year. Their MAGI lands around $139,000. That may still be a reasonable tax choice. But 2 years later, when Medicare uses that tax return, the retiree is no longer in the standard premium. They're in a higher IRMAA tier, which could add roughly $1,900 or more per year in Part B premiums compared to the standard premium, depending on the exact tier they landed in. And because Medicare is looking back, that higher premium can hit not just for 1 year, but for the period until the look-back shifts to a lower income year, often 2 years during early enrollment. The key point, the conversion didn't ruin their retirement, but the same conversion done at 61 or split across 2 years to stay under a threshold could have produced a similar long-term Roth benefit with far less Medicare premium pain. Second scenario, a married couple who doesn't even think of themselves as high income. One spouse earns part-time consulting income. The other spouse is taking Social Security. They also sell some old stock with a large gain and maybe take a small IRA withdrawal for a home repair. None of these moves feels extreme. They're just normal financial life events. But together, those items push MAGI high enough to cross into an IRMAA tier for joint filers. 2 years later, both spouses start Medicare, and both pay the higher premium. For a couple, the added cost can quickly reach several $1,000s per year. Over the first 2 years, that can become a painful, unexpected bill, especially because it's deducted from Social Security checks and feels like a penalty for something that already happened and can't be undone. And the frustrating part is that many of those triggers were controllable. The stock sale could have been spread across tax years. The IRA withdrawal could have been sourced differently. The conversion could have been sized to just under the cliff instead of well over it. The difference is rarely intelligence, it's timing awareness. Third scenario, the retiree with steady, modest income and no big controllable events. A pension, Social Security, no large IRA, no major investment sales. MAGI stays far under the thresholds. For this person, age 63 is not particularly special. They'll likely pay the standard premium and move on. That's important to say clearly because not everyone needs to obsess over IRMAA. But if you have a traditional IRA or 401k, a taxable brokerage account with appreciated holdings, rental income, or any other income source that you can choose the timing of, then you are in the group that can stumble into the trap. Now we need to address why age 63 is so often the collision point. It's because 3 different systems can all be affected by MAGI, and at 63, they overlap in a way that creates conflicting incentives. System 1. Income tax planning. Early retirement years often have unusually low taxable income. That creates an opportunity to do Roth conversions at lower marginal rates. Done properly, this can reduce future RMDs, reduce later life tax brackets, and give you flexibility in retirement spending without pushing yourself into higher taxable income later. System 2. Health insurance subsidies for people under 65 who are buying coverage through the ACA marketplace. Those subsidies are also based on MAGI. Higher MAGI can reduce or eliminate subsidies, which can increase annual health insurance costs dramatically. So, before Medicare, the incentive may be to keep MAGI lower. System 3. IRMAA for Medicare, based on the 2-year lookback. Your MAGI at 63 can raise Part B and Part D costs at 65. So at 63, you can be pulled in 3 directions. Tax planning says, generate income now while rates are favorable. ACA subsidy planning, if applicable, says, keep MAGI low. Medicare planning says, keep MAGI below IRMAA cliffs if possible. There is no universal right answer because your best choice depends on your IRA size, your expected longevity, your expected future tax rates, whether you will have large RMDs, your filing status, and whether you will likely face the widow or widower situation later. But there is one universal wrong approach: making a large, irreversible income move at 63 without running an IRMAA impact check first. Now let's make the timeline crystal clear so you can understand why this never feels obvious until the bill arrives. Medicare premiums in 1 year are generally based on MAGI from 2 years earlier. So, your 2026 Medicare premium is generally based on your 2024 tax return. Your 2027 premium is generally based on 2025. Your 2028 premium is generally based on 2026. This rolling pattern continues for as long as you're on Medicare. The lookback never stops. Every year, Medicare is pricing your coverage using old information. So why is 63 uniquely important? Because it's the first year that typically determines your first year on Medicare at 65. It's the beginning of the chain. After that, 64 matters too, because it affects 66. And once you're older and RMDs start, managing MAGI can become harder because distributions are forced. That's why earlier Roth conversions, done before 63, can be so powerful. They may reduce future forced income, and they may occur outside the look-back window for the first Medicare years. Now, what if you've already been hit with IRMAA? Can you appeal? There is an appeal process, but it's not meant for "I chose to do a Roth conversion." It's generally meant for certain qualifying life-changing events that caused income to drop compared to the look-back year. The appeal is often done using SSA-44. If you had a legitimate qualifying event, like retirement, loss of pension income, death of a spouse, divorce, or other qualifying situations, you may be able to get Medicare to use a more current year's income instead of the old return. But if your high income was caused by a deliberate strategy like a Roth conversion, Medicare usually expects you to live with the surcharge until the look-back rolls forward. The good news is that for one-time events, IRMAA is often temporary. The bad news is that temporary can still mean thousands of dollars you didn't plan for. There's another layer that is one of the harshest versions of the problem. What happens when one spouse dies? When both spouses are alive and filing jointly, the IRMAA thresholds for married filing jointly are higher than for single filers. When a spouse dies, the survivor often shifts to filing as single after any allowed transition period. The thresholds for single filers are much lower. That can cause the surviving spouse to pay much higher Medicare premiums on the same level of income. This widow penalty isn't just about taxes. It can show up as Medicare premium spikes too, because the same income that was under the joint threshold can land well above the single threshold. That's one reason Roth conversions can still be a very smart long-term protection move for couples, especially when done earlier and sized carefully. Roth assets can allow the survivor to spend from accounts that don't raise MAGI the same way, potentially helping keep Medicare premiums lower later. Now let's turn all of this into a practical action plan based on where you are today. If you are 60 or 61, you're in one of the cleanest windows for conversions. You can potentially convert more aggressively without having that income set your first Medicare premiums at 65 because it's outside that first look-back year. That doesn't mean you should ignore IRMAA forever. Remember, it never stops. But it does mean you have more flexibility before Medicare begins. If Roth conversion is part of your plan, these years are often the best time to execute a big portion of it. If you are 62, you're approaching the first critical look-back year. It's a good time to start coordinating a multi-year plan instead of making one-off decisions. You want to understand how much room you have before you hit a cliff next year and whether a portion of conversion should be pulled earlier or spread out. If you are 63, this is the year to stop guessing. Before you do any major conversion, IRA withdrawal, stock sale, or large income event, estimate your MAGI for the year. Compare it to the IRMAA thresholds for your filing status. If you are close to a cliff, consider whether you can reduce discretionary income, delay a sale, spread a conversion, harvest gains in smaller chunks, or use other planning tools so that you land just under the tier instead of just over it. This is not about being scared of income, it's about being intentional. Sometimes crossing a tier is still worth it if you are reducing future RMDs or preventing much larger taxes later. The point is to decide with eyes open. If you are 64, same concept. Your decisions now can affect your premiums at 66. Also, this is the age where some people begin Social Security, which can increase taxable income and reduce your flexibility. Coordinate the claiming decision with your tax and Medicare planning instead of treating them as separate topics. If you are already on Medicare and you got hit with an unexpected surcharge, first, confirm it's correct by looking at the tax year Medicare used. Second, ask whether you had a qualifying life-changing event that would allow an appeal. If yes, the SSA-44 route may help. If no, plan forward, because the look-back will eventually move on if the high-income year was a one-time spike. And if you are consistently near a threshold because of distributions and taxable income, consider tools that may reduce IRMAA. One commonly discussed tool for people age 70, 12 and older is a Qualified Charitable Distribution, QCD, where you give directly from an IRA to a qualified charity and keep that distribution out of AGI. It doesn't apply to everyone, and it has rules, but it's an example of the kind of planning that can matter once Medicare premiums are in play. Here's the big takeaway. The mistake isn't doing a Roth conversion. The mistake is doing a large conversion at 63 without measuring the Medicare premium consequence, or doing it in a way that unnecessarily jumps a cliff by a small margin. Retirees who avoid this problem aren't necessarily richer, and they aren't necessarily more sophisticated. They simply learned one key fact earlier. Medicare is pricing your future coverage with your past tax return. If you remember that, you'll stop thinking of 63 as just another year and start treating it like what it is, the year your first Medicare premium is being set. And once you know that, you can still convert to Roth, still harvest gains, still sell assets, still build a strong retirement plan, just in an order and an amount that doesn't create avoidable costs. Social Security Vault.